This is Yahoo Finance's Morning Brief. I'm Julie Hyman. Miles Udland is there. Here we find ourselves once again on a Monday following an eventful weekend where news flow didn't quite go maybe the way the market wanted to go, but the market is doing okay with it. I mean, you've been pointing this out that each new headline about the Iran war sort of has diminishing effects on the market. And we saw that even play out over the weekend when futures were down more. Now, yes, futures are still down about 1/4 to 1/3% across the board. But, you know, this whole view that the bottom is in, that the worst has happened, nothing has shaken the market's confidence in that belief. Even though we saw the U.S. attack a ship over the weekend as part of its blockade. We saw Iran say,
I spent a lot of time in a car this weekend. Can you hit me with like the 3 or 4 things I missed here?
So U.S.
Because I'm waking up, I'm like, futures are basically unchanged. What am I missing?
Ship tries to get through the blockade. U.S. says no, and basically like fires on the ship, stops the ship.
Saw that one. Right.
Iran says, actually, we're going back to blocking the Strait of Hormuz. We're going back to not letting. And then Trump's still saying, but we're still doing talks in Pakistan. Okay. The last I
saw that Friday, they were going to have a talk.
But then stuff happened over the weekend. Then the last I saw, Iran said, well, we're not participating in those talks, but that's not entirely clear because, you know, some of the time Iran talks through proxies or spokespeople. Sure. So that is where we find ourselves this morning. I mean, oil is higher this morning, so that's something to keep an eye on, but it's not nearly as high as it was. It's right now I'm looking at WTI that is trading still below $90 a barrel. So it's not back near the highs where it was. So, you know, all of that said, it kind of lets you know why we're not seeing stocks do worse.
Well, I think the market's action is, this has been a great period to learn about the stock market if you are so inclined to learn about what does and does not drive the headline price of the stock market. And what does and doesn't is expectations about what the future will hold on the basis of how it will, you know, this is guesswork, right? Like stock market is about projecting the future. And you can say a way to see the future clearly, like people say you can predict the future by understanding the present really clearly. The stock market oftentimes presents what appear to be contradictions along those lines. Things are bad now. Why are we so bullish about the future? But the question about the future is, based off that clear present picture, you form for yourself better, worse, better, worse, better. It's very binary. I think I like the stock market because it does work with declarative statements. My mother would always criticize me as a child for making very grand. I mean, I have people in my life who still don't care for this style of communication. It's always this. You never do that, right?
Yes.
But the stock market responds almost always to that kind of logic. There is a through line that you can draw over a 1 month, 3 month, 6 month rolling period. These were the 3 things the market definitely said yes or no to. So right now the market is definitely saying no to the Iran war gets notably worse than the depths that we reached 2 weeks ago. Yeah. That doesn't mean from here till whatever point in time there's going to be, we're never going to sit here on a Monday and have you rattle off all the headlines of the bad thing, right? Like I think we could probably do that every week for the next 6 months. Yes. But the stock market has very clearly spoken that where things looked like they were headed in mid-March, when you heard people talking about nuclear weapons, which was like kind of not really as material, but like we were having the conversation that we weren't going to be using nuclear weapons, which is not a great place to be. The market's like, we're not going back to that place. We've decided we're not going back to that place.
Yes. You know, and Scott Bessent, the Treasury Secretary, in an interview in the last couple of weeks, kind of echoed what you and I have been talking about, which is at some point this will be over.
Yep.
The end of it is probably closer than not at this point, and you trade as though you look to the future of that case. But I would also, another note really struck me this morning from a guy named Henry Allen over at Deutsche Bank, who was looking at the price of oil, because there still has been a lot of conversation about like, why are stocks at record highs?
Consternation.
When this is happening, some would say they would grapple. Are they grappling
There's
with
much
this
grappling.
question?
There's tons of grappling.
So to use our wrestling analogy, I guess.
Only in journalism do people grapple.
Do people grapple?
Wrestling mats and news stories. That's where you find grappling.
So, but there has been a lot of consternation about like, why are stocks at record highs when there's this war that still is going on and ships aren't making it through? And this guy says, well, even if you look at the other recent energy shocks that you've had for 2022 and some of the other, or in the Ukraine war, that oil did not get to, it got higher than it is now.
Yep.
You had also natural gas involved in the Ukraine situation, which you don't have as much a factor here. If you look at it in an inflation-adjusted basis, it looks even more favorable. So he says, the key point is his quote, the key point is today's shock isn't hitting the severity thresholds of past oil shocks on a whole range of metrics. So that too kind of brought it home to me. Yes, the headlines look bad. Yes, the oil isn't getting through. But there are reasons to say, to put this in perspective. Even if you're not looking past it, even if you're looking just at this snapshot in time and saying this isn't as bad as we have seen in past oil shocks for various reasons.
Yeah.
I thought that was interesting.
Yeah. I mean, I think to me on the oil thing, I don't know, there's really no reason to do a post-mortem. Like, it doesn't matter, we can just move on. but like 3 weeks ago and it's because it's still in the air. Like, there's this huge disconnect between the oil experts and the stock jockeys of oil experts being like, you don't understand that actually this is happening. And like, they are shocking headlines.
Yes.
$240 a barrel oil in Sri Lanka. The spread between the price of barrel in Oman versus what's being on the financial, like, I know there are disconnects all across the oil complex. What does the futures curve say versus current price? Like, all this kind of stuff. But that needed to fully break contain. Like, that's a really interesting story, and it's still a very challenging environment if you're an oil broker, if you have a ship full of oil barrels, if you're drilling oil out of the ground. I understand that this is the material that makes the entire global economy go. It literally greases the gears of the global economy. But like, there just was and kind of remains a little trickle of like, I think folks who are like fully in that world being like, how is everyone not, reacting on this metric, like along these lines and those lines and the others, because I am seeing the world one way. And I think my takeaway from it is things are interconnected, but they're so interconnected that you are actually able now to draw clear pictures of why this broken chain can be overcome with other areas of, however you want to analogize that. And I don't want to torture it too far. I've already done enough of that. But like, I just feel like, and Joe Weisenthal had a great meme, which was, are you familiar with the dancing party meme, where there's someone in the corner being like, they don't understand?
Yes, I saw your retweet of that, yes.
And it's just like, so he does that, and he just nailed it, right? It's like, there's just a group of folks who are looking at things like, I don't understand basically how stocks are to record. And it's like, I don't know what to tell you. Study S&P 7000. That just is what it is.
Well, and so I was also looking at a note from Ed Yardeni this morning where he basically said animal spirits are back. Like that optimism that is bubbling underneath the market that you and I have been talking about. Yeah. His target for year end is 7,700. And he says, we're probably going to go back. Like, at this point, it's likelier than not that is achievable, that we could get to that level. He's pointing to earnings like so many people are right now. Like, nothing has, the oil picture, at least as far as we have seen, has not derailed the earnings outlook. If anything, earnings estimates are moving higher, not lower. That's making PEs more attractive also, by the way, the valuations in the market. So, listen, I typically will take the other side of something. I like to look at the other, if your hallmark is making declarative statements, mine is arguing the other side of something. And I tend to see things a little more in gray than in black and white.
Endlessly drilling down on the nuance.
Yes, sure. Exactly. Yeah. And so, so I'm not going to say like pound the table and say like this is a great market, but like I see that there are reasons to be optimistic.
For every it's so over, there's another we're so back on the other side.
Exactly.
That's where we are now.
Yeah, I guess we are there now. Yep. Let's talk about something else that's we're going to be watching.
Yeah, we're beholden to the schedule now. I'm just seeing this for the first time here out of the corner of my eye.
Yes.
The rundown bar.
Oh, is that where we're going now?
We're going.
Oh, but okay, so now, we're toggling to Warsh hearing.
See?
Let's do it.
First time for everything.
Okay.
We're following orders here.
I didn't know we were. Are we talking in depth about Tesla earnings? I guess we'll get there.
Mention it.
Okay. Yeah. Okay. So let's talk about Kevin Warsh, shall we? Here, the wealthiest potential Fed chair in history, with the hundreds of millions of dollars in net worth here. So his confirmation hearing is tomorrow.
Yep.
So there's two questions. One, whether he'll be confirmed, because Tom Tillis has said he'll block the nomination while the investigation of Jay Powell and the Fed are ongoing. And two, what's he actually going to say in these hearings? And is he going to really hold fast to his thesis, which has been AI is going to boost productivity. That means we don't have to worry about as much about inflation, and we can cut rates. As Nick Timmeros pointed out in the Wall Street Journal this morning, most of the Fed members who have been out speaking about all of this don't seem to share that view, or don't seem to share that view that we're there yet enough, and that we're safe enough to cut rates. And, so will he sort of couch his past commentary in these confirmation hearings? Will he back off of it at all? Because that productivity, his argument is like you have to get ahead of it, right? You can't wait until the productivity comes. You have to cut into it. I don't know how, I don't know whether that argument is going to be bought by the members of Congress or the other members of the Fed.
Well, I think what's interesting about the way you framed it there is like the first question of will he get confirmed, essentially the politics of it, I kind of suspect will take up the vast majority of the confirmation hearing. And it's an interesting question on like, will he get confirmed? But speaking of like long timelines, he's going to get confirmed. Whether it's in 3 months, in 6 months, whether it's in time for the May meeting, probably not in time, or in time for the June meeting, I guess would be the first one. So I suppose that whole second discussion, which is like, what does Kevin Warsh, Fed Chair Kevin Warsh, think of policy and how these major themes do or don't feed through? I'm sort of ready to be disappointed tomorrow that doesn't come up, because I am very interested in that. But I sort of just think the lines of questioning are going to end up being, and also on the first part too, is how do you view Fed independence, and will you be pressured by the president to cut rates? Like, are you going to be independent, or are you just going to let yourself get bullied around by the president who nominated you? Which, again, is an important conversation, but is a political one. It is not one on a nature of like, what does Kevin Warsh think of policy? That, I think, we're probably just going to have to wait till he gets in the chair and then does the meeting every 6 or 8 weeks. And then we'll start to have a very I think it's a very interesting conversation about what a Warsh-led Fed looks like. I just sort of don't think tomorrow's the day we're going to find out.
I wouldn't be so, and I wouldn't.
Maybe I'm too bearish.
I wouldn't be too complacent that he is going to get confirmed on a shorter timeline. There is at least an outside chance that it will take, because there's the question of like, who's going to blink first? Is it going to be the Justice Department ending its pursuit of Jay Powell? Or is it going to be Tom Tillis? Now, I talked to Henrietta Trace, who we talk to all the time, who is a policy analyst at Veda Partners last week, and she said Tillis is in office through next January. He's not running again, but his term lasts until January. So if they're still doing the investigation, she said she doesn't see, her perception is that Tillis is not backing down.
Because he's not on the campaign trail, but many of his peers will be.
As she put it, Tom Tillis is living his best life.
Right.
Like, imagine being a politician where you're not subject to having to be reelected.
Senior spring.
Yeah, the senior spring. What a system we have that you can only operate on your principles if you're not seeking reelection. But that's a discussion for another day. Anyway, so if Tillis is not going to blink, and if the Justice Department isn't going to blink, Warsh might not be in place for a while. Maybe, and Jay Powell could still be on the Fed board. But what's more, even if it is a Warsh-led Fed, as everyone who we talk to who's a Fed wonk emphasizes, the Fed is not just one person. And so it's not just what a Warsh Fed's going to look like, but does he have the capital, the intellectual capital, the influence on the committee to convince the other people to follow his view?
Well, I think, I guess thinking of timelines though, like as you were talking about his view on the disinflationary force of AI and like will it cut rates near term, I guess I view that as just like it's a time scale question of that's a really interesting probably 2028 conversation for the Fed, because it's sort of AI again, we had comments over the weekend again from Dario Amodi about we're going to 50% of white collar jobs are going to be gone within 1 to 5 years. Like all this stuff the AI industry keeps saying kind of makes the current moment feel like, which way are you going to break? Are you going to view that as an inflationary problem or as a labor market problem? If you go the inflation route, then there's a reason for the Fed to be, I think, proactive around cutting rates, possibly, right? You could say maybe 3.5 is not exactly where we need to be. Or if you're on the labor market side, then you're going to be, very concerned about like the overall health of the U.S. economy,
Right.
the vast majority of consumers, all this kind of stuff. I think the way I outlined it there makes it obvious to me that it has to be the former and not the latter, because the latter is like science fiction book kind of stuff. I mean, maybe we're going to end up there. Maybe they can run this clip in the documentary in 2031 about how everyone lost their jobs in the late 2020s. I choose to, I don't choose. To me, the evidence doesn't feel like it's actually heading that direction.
I just think we don't know yet.
Well,
That's where I'm
I
at.
kind of think Mark Benioff said we do, but we'll do that after we do Tesla.
All right. I guess
Let's do Tesla.
Okay.
All right.
Let's do Tesla.
Tesla results are out Wednesday after the market closed.
Mm-hmm.
What do you make of the Tesla earnings experience these days? And I say this in that the call is not quite the same format as most of the earnings calls you hear on Wall Street. And it has felt to me over the last, like this time last year, the whole call was about Elon, Doge, what are you doing? This was the call where he kind of signaled, like, I'm coming back to Tesla. The Doge thing is kind of really winding down.
Yeah.
That feels like way more than a year ago, given all the changes.
Yes, it does.
But because Elon is such a singular figure with so much to say on so many different areas and has so many different interests, I kind of wonder if the Tesla call tomorrow turns into like a faux SpaceX roadshow meeting. Not that he wants it to be, but that the questions end up being about where does that whole part of the Elon portfolio fit into Tesla now, given the SpaceX IPO moment feels like it's possibly coming before the next Tesla earnings call. This might be the last time that you have Elon doing one public company earnings call,
Right.
because there's going to be the SpaceX call, in 3 or 4 months from now.
Well, is he going to lead the SpaceX call, I wonder?
I think if he's on any call, he's just de facto leading. Technically, I don't think he's the leader. I feel like it's been their head of IR who's done as much talking as Elon. It's just a lot of the questions end up getting funneled.
Right, and
in
Gwynne
Elon's
Shotwell
direction.
is also, I imagine would want to hear from her on the SpaceX call. But in any
Anyway,
case,
fine.
I
There's a little
care.
bit of a meta conversation here, but
Overall, I just care less about Tesla earnings than I used to, I think is the bottom line, because it's still a car company and it's not doing as well on that basis.
Mm-hmm.
That it's just less exciting than it was, even with, the robo taxis, and I don't know. I just think like a little bit of and part of it is because the attention has shifted to SpaceX.
Okay.
Part of it is because the core business isn't doing as well. I don't know. I have trouble getting as excited about it. I'm
Video
sure
of
I will.
monthly sales updates, so we have
right.
a sense
Yes.
of where Tesla
Yes.
sales.
I'm
Tesla
sure I
sales
will.
are improving marginally, from where they were a year ago.
Yeah.
We got all that.
Yeah.
Expectations are for 22 billion some odd in revenue.
I'm sure he's
up a
going to
little bit
talk.
from a year
I'm
ago.
sure he's going to talk about robots.
Yeah, a lot of robot talk, self-driving talk. Where we at with the robotaxi network
Yeah,
talk.
and it feels like that.
energy business talk.
Yes, I'm sure. And there's been some stuff out lately that FSD, full self-driving, quote unquote, is not like that the adoption, or that there's some pushback on the part of some of the drivers to that. So, presumably there'll be some questions about that. Listen, it's not that I'm not interested in Tesla, to be sure. I just feel like there's maybe also it's a factor of that there's just so much going on.
I guess the other thing too is you forget, I forget, like, I don't know how long ago some things are. Because to your point about Tesla earnings, we would have sat here in 2017 or 18 and done the whole make or break quarter for Tesla routine.
Yes.
And
maybe that's why.
You know what
it doesn't feel like the stakes are as high right now.
Of course not, because it's one of the 10 biggest companies and has been, and there's impassioned conversation about what price the stock should trade at. Does it work? Does it not work? Is it going to go up? But I think the question that faced Tesla in what is now further distant past, 8-10 years ago, but it was like is this thing really going to make it to the level that Elon thought it would? And meaning, are they just going to sell as many cars as the company kind of talked about? And I didn't go back, I haven't gone back in this exact moment and been like, what were the projections for 10 years forward, 10 years ago, and how far off are they in terms of how many cars they sold? All I know is I walk outside and there's just Teslas everywhere.
Yeah.
And the idea that Tesla isn't going to be one of the main consumer choices when you're going to get a new car and you're in a certain price range, for the foreseeable future, like that question is just over. Everyone's driving a Tesla.
Yeah.
So that is like, we were growing up in a business media environment when it was a big question of like, is this thing going to make it? And now the robots are super interesting. The whole Elon portfolio is super interesting. But you're right. It comes a week before the Mag 7, and there's not it's not doing the kind of CapEx that some of its other peers are. The questions facing Tesla right now are just not as like business critical. They're interesting on a, I don't know, theoretical level,
yes,
but they're just not as business critical. Like the business of Tesla is what it is, and it's in a good place, and it's kind of, it's evolving, let's just say,
yes,
right?
Yes,
but it's not facing like extinction, which
no.
Some people said it was facing not that long.
And it's also not facing like enormous, amazing outperformance at the moment either. It's just kind of, it's there.
Yeah.
All right. Well, okay.
Fine.
Since we talked about robots,
we'll talk about Tesla tomorrow, and then we'll do it on Wednesday.
Okay.
And Thursday.
Should we talk about robots?
It 2 more times. Let's do
because I know you're very passionate about.
Are we going to show the video? Do we have the video?
I don't know if we have. We got the
We'll
video.
show the video.
Okay.
Okay.
Robots ran a race.
Here we go.
In China, a half marathon, and one of the robots won. But as you pointed out, not before falling over before the end, right?
Yeah, the
crashed into
robots
something?
were falling all over the place. Right. I think he just fell over.
This is what humanity needed, was a fast robot?
Fast
humanoid robot?
What's your take on this?
My take on this, I don't think we should be spending our time and resources on humanoid robots.
Here we are.
We have, like, the distance between generative AI and AGI is much smaller than the distance between that thing and a human. Because it was purpose-built to run the race. It can run the race fine.
Yep.
But the ability, like,
sure.
I just don't feel like, the use case for a humanoid robot to me is much less than the use case for many different purpose-built robots, and we don't need a race-running robot.
Right. Well,
in my view.
We definitely don't need a race-running robot.
No.
I suppose I was and remain confused of the headlines being like, a robot set the world half marathon record. I was like, that's just not a thing. Like, I don't know what we're talking about here. Like, it'd be like, oh, a person on a bike broke the world half marathon record. It's like, yeah, they're on a bike.
It's a different thing entirely.
It's a robot. To your point,
yes.
it's like, I guess
it's not like Guinness is putting the robot in the book.
It uses 2 like metal struts that appear vaguely leg-like and travel 13.1 miles. In no way does this have anything to do with the world half marathon record.
Yeah.
It has nothing to do with it.
I'm with you.
But that was the framing of the, it covered the half marathon in I think 50-30, something like this. And I don't even know what the half record is.
I have no
56,
idea.
57?
I don't remember what it was.
I remember when an hour was a big deal, but I feel like we're way past that. But yeah, like I'm still kind of confused. I mean, we're part of the problem now. We're now the mainstream media discussing the robot breaking the world half record.
But we're making it clear that it's not breaking the record. Does the lower third say that it? Oh, it does say it hit the world record, guys. Guys, were you listening to Miles in the meeting? We should have written this on the banner.
I'm going to go home and I'm going to get a bike out of the garage. I'm going to ride 13.1 miles around town.
You beat the record, congrats.
Faster than 55 minutes, and then I will be a record breaker. I actually don't think I could do that on local streets. That's like 25 miles an hour.
Yeah, I'm
right?
sure, but I'm sure somebody could.
Just go really fast back and forth past East Orange Golf Course. It's probably the best chance to do it.
We know what Miles' weekend plans are.
Weekday plans. It's too cold. It's like 50 degrees outside. 45.
Is that too cold for cycling?
Yeah, because you're moving.
I'm not a cyclist.
Well, I mean, you could get out there, I guess. I'm not either. I'm pretending to be.
All right.
I'm one of my dreams. That's it.
On that note, is that it?
We don't have an ad read today, so we got to go.
I know. What's our target out time? I don't even know
it's like
the show anymore.
Yeah,
okay.
Now.
That does it for Morning Brief. Coming up next is Opening Bid with Brian Sazi.
It's Monday for the markets. I'm Yahoo Finance Executive Editor Brian Sozzi, coming to you live from our New York City headquarters. Here's what's on my mind. What's on my mind today is something short and sweet and a little bit erring on the side of tough love. And I don't apologize for this, guys. If you loved stocks last week, if you were swept up into the bullishness that powered the S&P 500 to fresh records, if you were salivating when you hit the buy button on one of the hottest stocks in the world this year in SanDisk, then you have to love stocks this week as well. Last week, and everyone else ignored the concerns on the Iran conflict, preferring to wager on amazing days ahead for the global economy and corporate earnings. The war doesn't matter anymore to markets, pros told me. So many of them told me this. The fundamentals are great. That's despite a consumer sentiment report hitting a record low. All this means you eat you know what today, and you stay long stocks despite new volatility as it relates to the war. And you know what I was referencing there. Remember, you are looking past the war, so why are you so worried about it today? It's aftershocks from high oil prices, inflation, consumer angst simply doesn't exist. Am I right? Here on my Open to Bid Roundtable, Tom Messe, Sevens Report Research Founder alongside Yahoo Finance, senior reporters Brooke DePalma and Inez Frey. All three of y'all probably think I've lost my mind. Tom, coming to you out of the block. If you loved stocks last week, you have to love them this week, right?
You're absolutely right, because nothing has changed. And I get the U.S. seized an Iranian cargo ship, and Iran shot some bullets at some French and British-owned cargo ships or tankers or whatever. That really doesn't matter, and I'm not saying that flippantly. The only thing the market cares about with this conflict is that we do not see a situation where oil could spike above $150 a barrel all the way to $200 a barrel and really cause a problem. I said this this morning. Whether it's 65, whether it's 85, whether it's 90, it's really not that important to the economy. It's what markets care about is it's not going to escalate up to $150, $200 a barrel. And for all the noise, it looks like they're still meeting tomorrow in Pakistan, the U.S. and Iran. They're going to sort of hash something out, most people expect, and it's going to take that expectation being removed before people get more nervous about this. And I get it's counterintuitive, but you're absolutely right, Brian. If you were chasing them yesterday, or if you were chasing them last week, you better be buying the dip on the open this morning.
Let's be clear, Tom. As earnings season ramps up, we are now not all, we were, I think, coming into this earnings season, we were hoping for the best. But now earnings, given how far markets have come back, we need home runs. We need a home run from Amazon, Microsoft, the rest of the Mag 7. We need home runs from industrials, really across the board.
Yes, you do, because earnings growth is a major underappreciated positive for this market. Talking about earnings can sometimes be like white noise for investors. There's so many companies, the earnings get so complicated. But really, the stock market is driven by earnings growth expectations. That is then tied to economic growth and macro factors. The reality is companies are making more and more money, and we're seeing this accelerate. And despite all of the concerns, whether it's tariffs last year, whether it's the war this year, the companies continue to execute incredibly well. And that is the underpinning. That is the heart of this market's unbelievable resiliency.
Brooke, the team early this morning, we had a morning meeting. They say Brooke is looking to has some data on market melt-ups. And look, I'm a sucker. Anything that relates to market melt-ups, meltdowns, I'm your guy for that stuff. Hit me with it.
Yeah, right now what we're seeing is Edgar Denny of your Denny Research predicting that there's a 20% chance for a market melt-up, a 20% chance for a market meltdown, and a 60% chance that we'll continue to see that roaring 20s scenario. The word melt-up, this hype among investors right now, that fear of missing out is causing such momentum within the markets right now. And the word melt-up was in so many different analyst, strategist notes across Wall Street this morning and over the weekend. And largely what we're seeing is because there's this consensus about the momentum that we're seeing, as Tom noted, within earnings estimates. Goldman Sachs now saying that consensus earnings estimates are about up 4% than what we were back in January for both 2026 and 2027. So lots of excitement and this thought that we'll continue to see the major indices move higher and higher. And now, as we're seeing a bit of a pullback this morning, as Tom was saying, perhaps now this is a time that investors might think to hop in. Over the past few weeks, we saw 13 consecutive days of gains for the NASDAQ. That's the largest since 1992. And if we see a 14th consecutive day, that'll be the largest since 1987. And so will this melt up continue? Will investors continue to have this fear of missing out of this market?
Brooke, did you write this story? 20 reasons for a stock market melt up. I mean, that's like perfect material for our homepage. I'll let you go if you want to go write that up. And as I think Tom brought up a good point. I mean, let's go into your domain of oil. As long as the market doesn't think oil prices are going to hit $150 a barrel again, I mean, maybe stocks are just okay.
That's right. And if you take a look at what oil is doing right now, I mean, you had over the weekend the news that Iran said, okay, the Strait of Hormuz is not open now. You had the U.S. saying that they have seized an Iranian vessel. And you are seeing oil up more than 3% right now. Meanwhile, last Friday, when Iran had said the Strait of Hormuz is now open, you had oil tanking 10%. So obviously, the market is indicating that at some point the situation is going to normalize. Otherwise, you would see oil going much higher today. So the market is expecting that, yes, at some point, this is going to normalize. There is a difference between what the physical market is paying for oil and what the futures market is saying, but it's looking past this for now.
Tom, is the NASDAQ melting up?
It's looking that way. I think 13 straight days, I don't know what the official definition of a melt up is, but 13 straight days is pretty substantial. I think that sort of what is important to this melt up, though, is why it is happening. I think the first stage of this, honestly, most of these 13 days, has been funds that got underinvested or maybe a little too light into all this volatility, trying to chase stocks higher. And we call these the Mag 7 stocks, the mega cap tech stocks, long only rentals, which means if I'm a fund and I need to slap on exposure really fast, then I need a liquid stock that trades with a high beta to the market, and I look right to mega cap tech. And so I think a lot of the gains of the past 13 days have not necessarily been fundamentally driven in these tech stocks, but just a lot of funds and investors trying to slap on exposure. Now we're getting into earnings for these tech stocks. And if they're good, then you're going to see this thing just turbocharge. And so I think it is a lot about earnings. And I think the sort of the pieces are in place for a continued melt up in the tech stocks.
Tom, switching gears just a little bit. Of course, this comes against a backdrop. We're supposed to hear from Fed Chair nominee Kevin Warsh, I believe, tomorrow. The average investor knows squat about this guy. We haven't really heard much from him in the past 12 years. Don't really know who he is. We keep seeing the same 5 photos out there on the internet of Kevin Warsh. But we do know a couple things. One, he doesn't really want to communicate with the media, so we might get less communication if he is confirmed as Fed chair. And then he's not really big on buying bonds, which might have ramifications for the mortgage market. For the average investor, Tom, what do they need to know about him, and how might he shape the stock market if he is confirmed?
So I think that the net takeaway for a regular investor from Warsh is that he isn't going to rock the boat. Look, there are concerns that he's maybe not as big of a fan of QE, and that maybe he's a bit more dovish structurally than Powell was. But at the end of the day, it's a committee. And yes, Warsh matters. But I in my career, at least, and guys, correct me if I'm wrong, but I've never seen a Fed more divided. I've never seen a Fed committee that is more sort of torn on what they need to do. And investors need to remember, the Fed president is not the king of the Fed. He has to form a consensus, and the majority rules. And so I think that Warsh will come in. I think that obviously he will make some changes around Powell, but it's not something I'm particularly worried about that he is going to radically alter the Fed. Frankly, I think a little less communication from the Fed would be a good thing from the market. We hear from them too much, and they don't really say anything. And so, making communication a little less frequent, but a little more valuable, I think would go a long way to helping the market.
And as Tom breaks up a good point, and I was thinking about this last night, this current generation in the market, let's say under 35 years old, they don't remember Alan Greenspan. I started my career watching his testimonies, and this guy said absolutely nothing. You actually needed a dictionary to figure out what he was saying. He spoke in another language. But since Greenspan, Bernanke, Yellen, Jerome Powell, all these Fed chairs, they have just over-communicated and maybe just injected more volatility in the markets than we needed.
They certainly parse out everything that they say. I mean, you had Jay Powell talking a couple of weeks ago about looking past an energy shock. And so then, therefore, the market anticipated, OK, then there will be rate cuts. Then inflation is not going to be as bad as we think because of the rising oil prices. So, yes, it's been a Fed that has telegraphed virtually every single move since what you're talking about. And this is what is fueling these bets on what is going to happen with rate cuts, expecting 2 rate cuts by the end of the year, and what Polymarket is expecting as well, what the bettors on Polymarket are saying.
I hope none of these folks talk under a Kevin Warsh Fed. They all could just come on Yahoo Finance, Brooke. This comes against the backdrop, too. It was interesting. I put out I reposted or tweeted, whatever you call it, a chart this morning by Charlie Bilello. He's over at Creative Planning. He had a picture of the S&P 500 record highs at the same time as consumer sentiment as at record lows. Like, it says so much about the divide between Wall Street and Main Street.
That's right. There certainly is. There's this rhetoric going on that if we continue to see the stock market move higher, we'll continue to see that high-income consumer outperform or outspend far more than the middle and low-income consumer. And heading into this year, Brian, I know you remember we were talking a little bit about that alligator, the low-income consumer maybe getting a little bit of a boost from those tax refunds, maybe doing a little bit better. But now that low-income consumer has been hit by higher gas prices, they certainly feel poor, or rather, they certainly feel less confident about their state right now in this economy. And so we're seeing this further bifurcation within this K-shaped economy continue, especially as we're now seeing the stock market really do better in the month of April, especially when it comes to that Mag 7, up about 14% when it comes to MAGs, the Roundtail Investment ETF, over the past few days. And so this is a economy where we're continuing to see that bifurcation. And I'm looking forward to hearing from companies like McDonald's or Walmart or even Target to understand how their consumer is doing and faring in this environment.
Brooke, you have a real knack for naming the economy. So I was trying to do it in real time. It's like I'm trying to get it's like the alligator economy. That's like the S&P 500 and consumer sentiment. Like, I mean, you get it all here on opening bid. Y'all have to stick with me, and I apologize in advance for that. Straight ahead, Amazon may be sitting on a monster first quarter earnings report. More on this next. When Amazon execs step up to the earnings day, Mike, on April 29th, they may have some bullish numbers to convey to Wall Street. And if that happens, AI juggernaut Anthropic may be a large reason why, explains KeyBank analyst Justin Patterson. Says Patterson, Anthropic has been a long-standing AWS customer, and its rapid growth in annual recurring revenue from $9 billion in December 2025 to $30 billion in early April of this year provides a meaningful tailwind to AWS growth. Anthropic has had a huge year on the development front. Mythos to Claude, likely pointing to the need to extract as much AWS cloud computing power as possible. Let's take this to the roundtable. Tom Essay and S4A, Brooke DePalma, and they're all here. Tom, are you a big believer in Amazon? The stock has ripped higher, probably in anticipation of what could be a very strong earnings report next week.
Yeah, I am, Brian. I think that they really chose the right horse to back in the whole AI races. I think that Amazon and Anthropic is sort of directly in competition with the Microsoft OpenAI partnership. And I think right now, AWS and Anthropic are winning that battle. I think obviously Claude has been in the news substantially. Claude, especially going into the enterprise, seems to have a leadership position there. AWS has been the engine of earnings growth for Amazon, 15 years and counting. And this injected a massive stimulus into that business, and it's only continuing to grow. So look, it's not like as Anthropic goes, Amazon goes, but Anthropic is providing an important boost. They are growing like a weed. They have the wind at their back, and they seem to be the AI of choice for enterprise, which is the next sort of level of growth for AI, I think. So yeah, all signs go, I think.
And as another point here with Amazon, last year, that AWS business, every single quarter, there was concern about growth slowing. I believe the sales result for AWS last year was about 20%. If Amazon could pick it up to a 30% plus growth rate this year because of Anthropic, as Patterson over at KeyBank suggested, that could be a major tailwind, not only to their sales, but also their profits this year.
And I think that that's the bottom line, is that AWS growth. Wall Street will want to see that AWS growth, and also that to justify its spending spree on AI. Another point that you had mentioned also, Sazi, is their chips, their custom chips, and whether or not whether they will be selling those to third parties. So that is also bullish for the stock. But I just want to point out that Amazon last year was the laggard among the Mag 7s. And going into this year, you had Wall Street saying that Amazon was going to be kind of like what Google or Alphabet did last year. It was going to outperform this year. So there's a lot of expectation that this year is going to be the year for Amazon.
Good point. And as Brooke, what was that Rufus thing you were talking to me about before you walked out of our building this morning?
I had to say it. I mean, Walmart has Sparky. Then you have other platforms have these sort of agentic e-commerce chatbots. And for Amazon, it's Rufus. And I was reading this note from City Out this morning, and what they were saying was that basically Rufus, also you have Alexa Plus, this retail demand and agentic e-commerce, how exactly that's going to play into this quarter will be critical on top, or if not after, what exactly we expect to hear from AWS revenue growth. And so this is really the story. This is kind of like all this hype that we've headed into Q1 earnings is now going to be at the forefront. We sort of heard all these different retail platforms lay the groundwork for these chatbots. I think this is the quarter where we'll hear more about the results from them. And that's Rufus.
Rufus and Sparky. Only in corporate America would you have names for AI products like this. All right, now switching gears. I have known Dan Schulman for more than a decade, first meeting him early on in his days as PayPal CEO. I've always known him to be a very thoughtful leader. He doesn't like doing interviews at conferences, for example. Rather, he goes to panels he thinks will be helpful to better understanding business and people. He practices Krav Maga. Go look this up on Yahoo Scout AI. I'm not explaining to you here. And he likes horses and the open range, which fits well with his longtime cowboy boots and jeans look. Dan left PayPal as CEO in December 2023, only to return as Verizon CEO last year, a company where he had already been on the board of directors. I think Dan is still wrapping his head around putting Verizon back into growth mode, although his decision to terminate 13,000 employees will help on the profit line. But Dan is starting to emerge again in media land. The latest in a weekend Wall Street Journal interview. The story highlights him predicting 20% to 30% unemployment within the next 2 to 5 years because of AI. He has also warned that advancements in humanoid robots could upend manual labor jobs. I do think, given his track record, when Dan speaks, we should take notice. So my question of the day is this: what would up to 30% unemployment mean to the stock market should it happen? Tom, no pressure. What do you think?
So, your natural inclination would be, oh my gosh, this is going to be a disaster for the stock market, and certainly that's possible. But if we're going to have 20 to 30% unemployment, then that likely will translate to 20 to 30% or more earnings growth for the companies that lay off all these people, right? I mean, in the end, when we talk about 20 to 30% unemployment out of AI, which I think is I certainly don't want to argue with somebody that intelligent and that successful, but I think that's quite a forecast. But the reality is they're just cutting people to save costs, right? So that should then trickle down to earnings and to profits for investors. So if you're worried about 20 or 30% unemployment, you better be all in on the stock market, because those stocks from the companies that cut 20 to 30% should theoretically skyrocket. Hopefully that helps you out if you're one of the 20 to 30% of the population that is going to be unemployed.
Yeah, Tom, you can invest your severance in shares of like NVIDIA or something. But Nez, Tom brings up a good point, and maybe a key reason why the stock market continues to hit new records despite geopolitical concerns. The layoffs are here. I mean, we've been watching big tech layoffs accelerate over the past 6 months. Of course, you had Snap, a week and a half ago? That was a very large number. As these layoffs continue, there's going to be a lot more opportunity for companies, not just in tech, to show some very big upside to their operating profits.
For sure, AI productivity is going to just soar, especially after the trillions that are being really thrown into it. But if you take a look also at the flip side of that, you do have tax receipts that would go down. You do have also 401ks that would not be funded. So there is that other flip side of what 20 to 30% unemployment would mean for the general economy. But what I will say is about these comments that Schulman has been making, it does show sort of thought and leadership as far as looking forward to what will happen to the market, to the job market, and kind of giving sort of a scenario, a sober scenario, and then as he mentioned in his interview there, it's just being authentic and being realistic about what will happen.
What's an interesting book, Brooke, we have seen the layoffs in big cap tech companies. The who's who, and even within the Mag 7. But we haven't seen these layoff announcements in mass in the industrial sector. We haven't seen it, or in the oil sector. We haven't seen it outside of tech.
I think that is interesting, certainly, but when you think about the productivity gains and the amount of investment that these tech companies specifically are putting into AI, it definitely makes sense that that's exactly where they're re-looking and reassessing their workforce. What I will say is that we did hear from retailers as of last year, including the like of tech giant Amazon, that they're certainly taking a look at their workforce and reassessing it to understand how AI will fit in. But I think that the advancement that the tech companies are making are just a little bit faster than the others that are lagging behind, and maybe that's why we're seeing it more pronounced right now. And if we'll see more of this spread out and head into other sectors later on this year, will definitely be interesting to watch as well, especially maybe as we head into the holiday season, what and how AI will play into the retail trade.
Tom, Brooke, and Nez, always good to see you all. I really appreciate it. Before you go, I dropped 2 new episodes of my Opening Bid Unfiltered podcast today that I think are amazing listens. Ancestry CEO Howard Hockhauser stopped by to share what's next for a platform still connecting people to their family tree. I went back and tested this thing soon, and I think I'm related to George Washington. And then the new North America CEO of Baby Bell and Laughing Cow Cheese, Peter McGinnis, stepped up to the mic. Peter is already hard at work visiting dairy sites and thinking up ways to cook up growth for the iconic cheesemaker. You can catch the episodes on Yahoo Finance, YouTube, Spotify, Apple Music, and Amazon. Market Catalyst with Julie Hyman is straight ahead.
Welcome to Market Catalysts. I'm Julie Hyman. 30 minutes into the U.S. trading day, and let's take a look at the major averages today. We're not seeing a heck of a lot of movement here, and what movement there is very slightly to the downside. This is, of course, off the back big rally that we've had, this winning streak for the major averages, record highs that we reached last week, and now a little bit of a breather, especially after some headline risk perhaps continuing over the weekend with regard to the Iran war. So right now we're seeing the Dow just down about 8 points, the S&P 500 very little changed as well, the Nasdaq moving the most, and it's only down about 0.1%. Let's go check on oil prices, of course, because that is still on the move given, again, those headlines that we have been getting out of Iran, but still below $90 a barrel, below $86 a barrel for WTI. So we are seeing that move higher, but we are not seeing the big spikes that we were seeing earlier in the conflict, and we still have a lot of strategists who remain pretty bullish on stocks. Now, looking at the S&P 500 and the groups that are on the move here, we see consumers discretionary, which had helped lead the rally, is now falling today, down about 0.75%. Energy, though, is moving higher. It has been moving pretty much in tandem with energy prices. And then looking at the Nasdaq here as we start to get into earnings season more in earnest, we're going to be watching Tesla, which reports after the close on Wednesday. Those shares off about 1.25%. We're seeing some red elsewhere on the screen here with regard to large cap tech. I also want to zoom in on software for a moment here because this has been such an interesting area thus far this year, really over the past 6 months because of the ups and downs that we've seen in the group. Here is today's move, which is actually pretty green here. If you look at the year to date for software, it looks a heck of a lot more red, but recently we have been seeing things kind of turning up there. So let's zoom in even further on software right now. We start with Adobe, which said today it was rolling out AI agents for enterprise customers. That's according to the Wall Street Journal. Adobe's releasing AI agents that will help its enterprise customers automate functions like digital marketing. And this, of course, comes amid that pressure I was talking about in the software sector that had sent Adobe shares down 30% this year. Joining us for more is John DiFucci, Guggenheim Securities Senior Software Research Analyst. It's always good to have you with us, John. So we start with Adobe, which is really just the latest company that is trying to subvert this sort of AI doom and gloom narrative and instead harness it, right, and offer it as a product to its customers. Do you think that's sort of the right way to approach it? And is this how software companies are going to end up succeeding?
Hi, Julie. It's great to be here. Listen, I think every software company, every traditional software company needs to embrace AI. We should be thinking about AI as sort of a new paradigm like the internet. So if you don't, join them, you're not going to beat them. And so you have to do that. But also keep in mind, listen, anytime there's a paradigm shift from on-prem to SaaS, for instance, the leaders of the last paradigm it's really difficult to bridge into the new paradigm. They're usually not the leaders of the next paradigm. Sometimes they can do it, but oftentimes they can't. So what Adobe's doing is the right thing to do. What Salesforce is doing is the right thing to do. What ServiceNow is doing is all of them, Oracle, Workday. But that doesn't mean they're going to be successful. But it is the right thing to do.
Well, so John, I mean, listen, if you don't know who's going to be successful, I don't know who will. I mean, you're really steeped in this industry. So how, as an investor, do I figure out what to buy and what's going to be successful?
Yeah, so the way I think about it is I think, okay, who are the technologists out there in software? Who are the companies that are based on deep technology versus the best go-to-market companies, the ones that market the best? Because you can be successful, you need both, but you can, if you lean into one or the other, you can be successful both ways. But when there's a shift in technology, I think you want to lean into the technologists. So, when Larry Ellison says something, I listen really closely. Of course, I listen when Mark Benioff or Bill McDermott say something, but they're more leaning into marketing. Like Salesforce had a lot of announcements this morning. You showed the stock up. I don't know, it's almost 4% this morning already. That's great. They're leaning into it. They actually said a lot about AI, and before they had anything, Agentforce was like, they didn't really have anything. Now they're catching up. with the technology. So they lead with marketing. Now, the problem is they led with marketing and people bought into it and it didn't really work. They did it again and it didn't really work. They're doing it again. But now they probably have something. We'll see how far it can take them.
John, it does feel like this sort of worst of, AI is going to eat all software narrative, that has ebbed a little bit, right? That, there is this recognition that these are, A, they're really entrenched systems and enterprises. B, there's more to this stuff than vibe coding it, right? Because you have all of the regulatory rails and all how the interoperability with all the other systems internally and all of that. Does it feel that way to you? And sort of like, what's then the next hurdle for these companies to overcome?
So yeah, you're right. The narrative was AI is going to kill all of software, like kill it. It's going away. It's not going away. I mean, I don't think it's going away. It usually a paradigm shift. Software has this staying power, this recurring revenue stream. By the way, most software companies, other than Microsoft, sell to corporations. They don't sell to consumers. Consumers are fickle. They change, they move around, they stop using one thing and use another. Corporations, if it's working, they keep using it. And AI can supplement that software. Maybe that software company won't grow as much as it was growing. Their relevance will cease to climb, and it'll just sort of, exist. But that's not it's going away. There's still some value in that. And some of these names are still trading below what I think that threshold of value is, which is like 5.5, 6 times recurring revenue. If the company was run like a private equity firm used to run a company just for cash flow, I think it's worth at least 5.5 to 6 times. And a lot of these companies are trading below that. So they're not going away. They're probably worth more than they're trading, including Salesforce. But are they going to be an AI winner and an AI leader? I don't think so.
John, something else I'm curious about as we talk about these companies harnessing AI, right? And using it to the benefit of their customers is we seem to be entering also a new phase with the large language model companies, with the Anthropics and OpenAIs of the world, that they're capacity constrained, that they're compute capacity constrained to some extent. That is, if you're using it, at some point you get cut off. Like you've used enough tokens, you've done enough usage. Is that going to be a problem for the software companies that are contracting with them, or will they be prioritized because they are big enterprise customers?
It's an interesting question because, as you know, the large language model companies, whether it's OpenAI or Anthropic, they have solutions too, and they're going to have more solutions. They're going to have enterprise solutions. They're probably going to prioritize that. But yeah, they'll probably prioritize this recurring revenue to them. I just talked to you about consumers. There's a lot of consumer revenue too. I mean, I utilize AI technologies myself just on my own, and so does my team, just to see what it's like and use it. But we move around a lot too. Organizations don't do that. So yes, they should prioritize them, but I don't think they'll prioritize the enterprises above themselves. And they themselves will come out with solutions too.
So is that going to be a challenge for some of the software companies at some point, or are they going to need to up their own spending on compute?
Usually they're usually in the compute world, or you're talking about hardware, really.
Yes.
And when things like this happen, and there's a greater need for them, there's a greater need than what's available. The world works really hard to bring that availability up, and that's what's happening today too. So I think you'll see that go up. You'll also see pricing come down. It always does. It comes down over time. Right now, it's really expensive, that compute, but it'll come down over time. And the companies that can do it really efficiently are the ones that will probably come up out on top. And that's why Oracle's our best idea for this year, because they're probably the most efficiently run data centers for not only AI workloads, but for traditional cloud workloads.
And Oracle, man, Oracle's had a wild ride, right? The stock has been coming back to some degree during this recent run. Where do you think Oracle should be priced? And what do you think is going to get the market to recognize its value?
So I think Oracle is grossly undervalued. And the reason for it is they have given us a lot of information, more than any other software company that I know of has given anybody. And it's about their future. It's about the contracts they have in place. And of course, they have one large customer, but they have a lot of large customers, actually. But one is overwhelmingly large, and that's OpenAI. And we estimate that the revenue from OpenAI will probably peak a little under 30% of their revenue at some point over the next few years. And but that risk, and there's always going to be that risk, okay? There's this customer concentration risk, but that risk is somewhat alleviated as OpenAI raises money, right? Because there was that concern of will they be able to pay Oracle? That doesn't look like it's as big a risk going forward. But even if some of that were to go away, Oracle, we think, like our price target is $400 on Oracle. Wow. We haven't lowered our price target at all. And we believe it will get there. We do believe it'll get there. Now, our price target is based on what we think it's worth. Now, based on what it's going to be in 12 months, I think that's the way most people look at it. But we're just looking at like what's going to happen to the revenue at Oracle, and we think there's going to be a cash flow waterfall in fiscal 29, which will be really interesting when that happens. So you ask when is it going to work? Well, it worked really well over the last 5 days. All the software did, but Oracle even more so. And we think that that will become obvious in 2.5 years, but it'll become very apparent in a year or so. So, investors are always skeptical when there's risk in the future, but they do stocks trade on the future. And when it becomes obvious that Oracle is going to see this cash flow waterfall, that's when the stock will work. So it's working, but it'll really work, I think, a year from now. People will realize this is amazing.
All right, we'll check back in. I'm sure we'll talk before then too. But John, I wanted to switch gears and ask you about cybersecurity stocks, because I know this is an area that you are really focused on also. And I've been thinking about it more with the whole Anthropic Mythos, partial release, right? And the new threats that AI are going to pose for cybersecurity. Do you feel like the companies you cover in the industry is up to that task?
Listen, yes. The short answer is yes, but let me caveat that. The reason why cybersecurity has been such a great growth sector for a long time is because we don't do it well. Like humankind, we don't do it well enough. So people have to keep spending on cybersecurity. It's kind of an odd thing, right? Like we're not solving the problem, so that people have to keep spending on it. I think that out of all the software sectors, other than infrastructure as a service like OCI and Azure and AWS and Google Cloud Platform, other than those players, cybersecurity is probably the only obvious beneficiary for AI. Because think about it, everybody, Julie, you can be a professional hacker if you want to be. Like anybody can be with AI. And that's why Anthropic was so concerned about Mythos. They're concerned that it's going to be very dangerous in the wrong hands. So they brought in these cybersecurity experts to try to help them to make sure that once it gets out there, they can combat any problems. So I think, listen, cybersecurity is probably, I see it like whenever there's an announcement, any kind of press release from any of the large language models that has security in it, the security stocks get hit. Until just recently when they talked about Project Glasswing, and they talked about the 40 names that are involved in that, and they named some of them, and those stocks went up. So I think that people are starting to realize that.
Besides sort of some of the legacy names that I know you cover, the CrowdStrikes, the Palo Altos of the world, I know you're enthusiastic about Rubrik. And I'm hoping you can explain what it is that makes Rubrik, it's at a good inflection point right now, and it is a good investment in your view.
So A lot of people look at Rubrik and they say, listen, this is a backup and recovery company. And they are, by the way. They are a modern architected backup and recovery company. They have a unique architecture. Now, others like Cohesity has a similar architecture. But because of that architecture, they were able to provide a solution for ransomware when nobody else had a solution. Nobody. And they were asked, and they did it. And then they came out with DSPM. They actually bought a company called Laminar, and people are like, what happened to that? Well, it's part of everything they do. Rubrik has this platform. They have a solution. It's not a portfolio of companies. It's a solution. And if you want that, if you want the identity resiliency, you just flip a switch and it's on, and you start to pay for it. So remember what I first said? I said, listen, I want to lean into the technologies.
Yes.
Well, Bipul Sinha, the CEO of Rubrik, is a technologist. He is solving problems that we haven't seen yet. Those are the kinds of companies you want to lean into. Yes, they're a backup and recovery company. And yes, I covered that in 1999. The whole world's changed since then, but they're a lot more than that. They're not just backup and recovery. And by the way, you mentioned, I think CrowdStrike and Palo would probably have a little problem with you calling them legacy. But I understand what you meant. But CrowdStrike, if there's a company out there that's public right now that you could say is an AI company that's core roots are AI, it's CrowdStrike. Listen, we don't even have a buy in CrowdStrike. It's an amazing company though, and they have a true platform too, and AI is at the center of it. It always has been.
That legacy was definitely not meant as a dig. It was more just like, how long has this company been around in public, et cetera, et cetera. So yeah, and the timelines are different when we're talking about tech anyway. John, always so fun to talk to you. Thank you so much.
I enjoy it too, Julie. Thank you.
Thank you. Take care. Up next, after the attacks in the Strait of Hormuz, oil prices are back on the rise. We'll talk about what's ahead for energy prices as geopolitical uncertainty returns or persists. Oil prices are back on the rise as tensions flared between the U.S. and Iran over the weekend. Both nations attacked ships attempting to move through the Strait of Hormuz. Talks could potentially resume Tuesday in Pakistan. For more on what this means for energy prices, we're joined by Rebecca Babin, CIBC Private Wealth Senior Energy Trader. It's good to see you, Rebecca. This doesn't stop, obviously, the back and forth that we've been seeing. It's interesting that we are seeing oil prices move higher, but not by much, right? We're still not getting to that $90 threshold. Have we seen the highs? Is there what's your floor and ceiling that you're looking at right now when it comes to oil prices?
So I think that's a great question, Julie. And I think the headline melee that we've been living through in the past month has really put a lot of traders on the sidelines. So I think it's important to realize that the volatility in the market has drawn many out, and liquidity is thinner, and risk thresholds are significantly lower. When we look at where the floor and ceiling is, it's really hard to place that right now with the information we have. I think if we can assume, which is what the market is assuming right now, that we have a resumption of flows through Hormuz at 50% in May and almost back to full resumption in June, you can kind of put this ceiling in crude in around that 110 to 115 level, right? And that's significantly higher than where we are. And I think that's partially because the paper market is looking through to the finish line of seeing those barrels. But the physical market's still stuck in the starting blocks. Those barrels aren't moving yet, and they take 3 weeks to get to their destination. So we're kind of not feeling that pain yet. We're looking through to the result without going through the process, so to speak. So in that situation, I think you see the top end at 115. Now, when we talk about the floor in that scenario, I think you're looking at kind of the 70s, low 70s for WTI in that scenario. And a couple reasons. Again, this is a market that has taken a lot of the excess fat out of it. We had floating storage, we had high inventories, we had a surplus. That's really been sucked out of the market. So the floor is naturally going to reside higher, especially since I think that many countries will start to think about stockpiling more aggressively going forward. So you got to raise the floor about $10 higher than where we were pre-conflict, kind of in this scenario where flows resume kind of somewhat normalized by June.
So, Rebecca, does that match up? I mean, we heard Energy Secretary Chris Wright in an interview over the weekend saying that we could see above $3 a gallon gasoline prices here in the U.S. persist through this entire year. And we've talked about before the sort of long tail of ramping capacity back up, ramping shipping back up. Does that match kind of your expectations?
100%, and it actually might be a little optimistic, to be honest with you. So if we're talking about crude, and we got to separate out products, and that's gasoline, diesel, jet, those products just don't have the same buffers in place. So all of the supply we've lost has really dug into the inventories very deeply, and we don't have refining spare capacity available. Even if a bunch of crude gets flooded into the market, you got to refine it and get it into a product, and that refining capacity is constrained. So we have two things working against products that mean that we'll probably see those higher prices sticky for longer. And the last thing to mention here is when we look at the infrastructure damage that's taken place over the last month, it has been to the refiners in the Middle East. We've lost about 2 to 2.5 million barrels a day of refining capacity. How quickly it comes back online is a question, but again, that just tightens the product market a little bit more. So I actually really think you'll see crude come in more quickly than products and higher prices for longer for gasoline, diesel, and jet.
Okay, so Rebecca, just to make sure I understand this, I understand that the United States is a net exporter of petroleum products. However, we don't produce the kind of crude that is made into gasoline by and large, right? Or at least not in size. So does that mean we are importing gasoline itself from the Mideast, or do we import the crude oil that then our refiners make into the gasoline?
That's a great, tricky question, Julie. So the way it works is we produce light sweet crude, which can be refined into gasoline. But we export a lot of that crude out and we import the products into the coasts on the East Coast and the West Coast, because where we're producing that crude, it's in the Gulf Coast and it gets exported out to other buyers. And our products also go to Mexico, to Latin America, leaving the coasts of the US needing to import those products. So this is more about logistics than anything else. Where do we need to import from? Where are the vessels? Where are our refiners? And can we kind of meet our own market kind of demand? Where we do have refining capacity is in the sour crudes. We have more refining capacity for heavy diesel. You'll see us import a ton of crude from Canada so that we can refine that into diesel. And that's where that net export number really is getting high. We are exporting a lot of that product to Europe and to Asia right now because we get paid, the margins are high there. So this isn't a global interconnected network. We have been very insulated from this event based on the amount of production we have and how much product we produce. This is a conflict that has really impacted those Eastern markets aggressively, and it's gradually coming west. But what we're seeing in terms of our pricing has been buffered tremendously by our ability to produce, refine some crude and products here.
Gotcha. So it could be even worse than it is in terms of that above $4 a gallon gasoline. But it sounds like bottom line, you think we're not going to see sub 3 anytime soon.
I don't think we see sub 3 in 2026. Maybe when we're looking into 2027, depending on how things play out over the course of the year and how quickly we get kind of the energy infrastructure back up and running. I think you could see it then, but I think for 2026, it'll be hard to get back down to those levels.
Rebecca, always great to see you. Thank you.
Thanks for having me.
Coming up, a look at some of this morning's top trending tickers. We'll be right back. Time to get a check on cryptocurrencies, brought to you by the National Cryptocurrency Association. Taking a look here at the cryptocurrencies, we see them little change, which is sort of matching what we're seeing across markets here today. A little bit of a pause after the run that we have seen for a lot of the different risk type assets. So here's the year to date with Bitcoin, a little bit of a breakout that we've been seeing here for those prices, and now the little bit of a breather that's now happening. In terms of headlines that we're watching here, there was actually a hack over the weekend that drained $300 million from a popular DeFi lending platform. So that's something that those in the crypto community are talking about today, and something that could be affecting sentiment. And then it's a Monday, so we tend to get headlines on what Strategy is doing, or what it did over the last week. And what we learned is that Strategy, formerly known as MicroStrategy, bought about $2.5 billion worth of Bitcoin last week. It was the most since 2024. That makes the total on its balance sheet about $61 billion. It financed that buy, by the way, with sales of its Stretch product, which is one of its yield-producing products that it has introduced in the last year or so. Here's a look at Strategy year to date. As we told you last week, it kind of perked into the positive year to date. But, you know, we've seen not a lot of upside for a lot of these various crypto stocks. So we'll continue to watch what goes on there. Time for some of today's trending tickers right now. We're watching, Brooke DePalma is with me right now. So let's talk about what we're watching. Let's start with Marvel. Google reportedly in talks with the company to develop 2 new versions of its AI chips. And we're seeing Marvel shares up by nearly 4%. Alphabet shares, Brooke, are little changed right now. You know, we have had a lot of these partnerships going on, a lot of these various hyperscalers trying to get their custom chips. And so Marvell's one that's been certainly talked about, but Broadcom is the name that has been most dominant. So it looks like this is a good move for those Marvell shares.
Absolutely, definitely a relief here. We know that Meta recently teamed up with Broadcom, as you noted. That one's been getting more and more attention, but the street's still largely bullish on Marvell. There's about 43 buy ratings, 7 holds, and no sells on the street. And obviously, investors pretty pleased with this announcement today. Shares moving up about 4% and also popping more earlier today. But it's worth noting as well that NVIDIA, that stock falling on this report, down about 1% last time I looked, largely because Google is a customer of NVIDIA. And now if they're into-house sourcing these chips, it remains to be seen what exactly the impact will be with that relationship as well. So all these different puts and takes definitely coming into play here.
Yeah, I mean, you know, and it's not, it feels like the hyperscalers are trying to get this chip capacity wherever they can. So they're definitely farming out a lot of these contracts to a lot of different chip makers and chip designers. Another stock that's trending for us, space. People are super interested in space right now, Brooke. It's pretty fascinating. And AST Space Mobile is on our list today, but the stock is down more than 8%. And it looks like the Blue Origin New Glenn rocket didn't place a satellite or didn't correctly place the satellite made by AST Space Mobile. So it looks like that's hitting the stock.
Yeah, Julie, you and I have discussed, I feel like so many times leading up to today, this momentum behind the space trade. So keep in mind, although we're seeing a bit of a pullback, this stock was up nearly 8% year to date, as this excitement around the space economy has definitely come into play for investors. I was reading a little bit more about what exactly happened here. Essentially, this was going to be used to further advance satellite internet service for smartphones. So this is something kind of a different back end into this space trade. It's known that AST Space Mobile needs to put about 45 satellites into space. This was just one of those satellites now, because it wasn't essentially launched exactly how it needed to be in a lower orbit. Now it needs to deorbit. So essentially, as the company makes this satellite come back down to Earth, it will burn up. So obviously a loss there, and that's why you're seeing the stock under pressure today.
Yeah, Louis DePalma, who we speak to over at William Blair, said it could have been worse. There was only one satellite on board, so at least they only lost one.
Exactly.
You know, I guess that's the silver lining, he says, for this situation. And then finally, here's an interesting story.
Right, with 45, definitely.
Yeah, definitely. And then finally, psychedelic stocks, are watching those. They're getting a boost. President Trump's latest executive order expedites research and access for these psychedelic companies and psychedelic drugs. really an interesting move here, and this is something that we've seen sort of loosening up in this administration.
Yeah, this is super interesting. This will essentially cut the time for the review process from 6 to 10 months to only about 1 to 2 months, with some experts saying that we could see these drugs come to market as soon as this summer. This could have huge implications for the mental health industry, for addiction, for depression, PTSD, especially among the veteran community. I was looking in my inbox and I've already gotten a few folks weigh in on what exactly the implications this will be for veterans, for the mental health industry overall, and many applauding it, many saying that this move is good and that before this does come to market, they'd have to take trips elsewhere in the world in order to gain access to this key component. I want to make sure I say it right. Ibogaine, I believe is how you pronounce it. And so it'll be really interesting to see if this does come to market, how exactly it'll be issued and covered by insurance. And also this sort of gives investors this stamp of approval, especially for these companies.
Yeah, definitely. And in the past, they couldn't even do research on some of these components because of the restrictions on them. And worth mentioning as well, Health and Human Service Secretary Robert F. Kennedy Jr. has been a proponent of these types of therapies. So we'll continue to follow this one too. Thanks, Brooke. Appreciate it. Coming up, what sets Anthropic's Mythos model apart from other AI efforts and why the company has called it dangerous. AI world is abuzz over Anthropic's new Claude Mythos model after the startup called it too dangerous to be released to the masses. Zach Cass is global AI advisor and former head of go-to-market at OpenAI. And Sherry Davidoff, the founder of LMG Security, they both discuss with Yahoo Finance what sets Mythos apart from other models.
Layman's terms, it's a much more capable model that has both coordination and intelligence upgrades in agentic properties that actually allow it to sort of not just go forward and backwards as it executes tasks, but could step side to side. And in doing so, is just much more capable of executing tasks and goals on an individual's behalf across applications, data lakes, and browsers.
You say here, Zach, though, we've seen this movie before. That's how you put it. So I guess let's cut through the hype there. I mean, is this really a historic breakthrough, Zach, or are you suggesting, no, there's some element of sort of branding and marketing going on by Anthropic?
Well, both can be true. So I think we should be really clear. As these models get more capable, we are enabling a lot more to happen, both good and bad. And this presents the promise and peril of technology and artificial intelligence in this case. And we should acknowledge that as excited as we are to see us cure cancer, we should also be equally anxious about what low resource bad actors can do. And when I say we've seen this movie before, what I mean is humans have a proud history of being very anxious about technology that we build, especially on the eve of its adoption. And you don't have to go back that far to find headlines about GPT-2, OpenAI's model that was built in 2019, and the concerns that we had about it and what it would enable low resource bad actors to do. Obviously now, given the fact that we are operating on a pretty antiquated internet with a lot of antiquated cybersecurity policies, Mythos presents new surface area to be exploited. And that in and of itself is reason for the companies to be concerned. But it doesn't mean that it's new in that, we are upgrading our humans' ability to just do more things.
Sherry, bring you in here. I'm curious, who do you think should be sort of paying the most attention to this, most worried about this, Sherry? Is it everyday consumers? Is it Sherry and Josh? Is it the small business owner? Is it the large multinational? Is it all three, Sherry?
Yeah, make no mistake, this is going to affect everybody. But I would say certainly anybody involved in a small business or a mid-sized business should really be paying attention. We have a case right now of the haves versus the have-nots. There's about 40 tech companies that have access to Project Glasswing. And the reason this is important is because Anthropic's new model is able to find vulnerabilities in software and exploit them at a pace faster than anything we have ever seen. So that means anybody that gets their hands on this essentially has like the closest thing we have to a hacking right, can break into things. And vendors, people that make software, don't have time to patch those vulnerabilities. They are working probably around the clock right now trying to patch these thousands and thousands of vulnerabilities that have already been discovered, and they will only find more. So again, there's some tech companies that already have their hands on this, and we're going to start to see the impacts trickle down in the form of new software releases, updates, more patches, things like that. So we all really need to be paying attention and applying those updates. Yeah,
I was going to ask you, Sharon, if I was a business owner, I was listening to you, I'd be getting kind of nervous at this point. Are there steps I should be taking?
Yeah, first of all, think about what you have that's facing the internet. If it doesn't need to be on the internet, don't put it there. There's a lot of times we can take software, put it behind a firewall. It doesn't really need to be a website out there. So that's first and foremost, step number one. And then step number two is talk to those who provide you with software, whether it's a third-party IT company or your software providers. Find out how they're going to be dealing with these vulnerabilities and the patches that will be coming out, and make sure that you are on the priority list, that you're going to be getting these updates right away, and pay attention to those.
Zach, back to you. Anthropic CEO reportedly, Zach, you saw this, meeting with the White House today about Mythos. I'm curious what you make of that, Zach.
I would love if our government has the latest and greatest technology, whatever it is. And I'd certainly hope that we have much better coordination than we've had in the past between Silicon Valley and the White House. And I think that the current administration has shown glimpses of being far more cooperative with Silicon Valley. In some cases, obviously, the recent dust up between the two is suboptimal, I think, really for everyone. So I'm frankly just glad to hear that they're going to patch things up.
Should we assume, Sherry, that foreign adversaries, Russia, China, have similar capabilities, have a mythos of their own?
I love that you asked that question. And yes, Anthropic, they're a company that chose to announce this to the world. But who's to say that China doesn't already have this, that the US government doesn't already have something like this? So this is the one that we know about that has been announced in a press release. These capabilities may well already exist in other hands. And frankly, any researcher or any tech company that does have access to Project Glasswing, we have to assume that they're targets and that other actors are going to try to get access to this as well.
Zach, Sherry, great discussion. Thank you both, guys. Appreciate it.
Coming up, we'll look ahead to Tesla earnings and talk about why Elon Musk might be eyeing a potential combination of his companies. We'll be right back. Tesla earnings are due out this week with questions over weakening demand and its self-driving future lingering. Joining us for more is Stephen Gengaro, Stifel Next-Gen Transport Analyst, and he maintains a buy rating on Tesla with a $508 price target. Steve, it's good to see you. I was talking with my colleague Miles Udland this morning, and it feels like Tesla earnings are sort of less of an event than they used to be. Like at a point where it was like every quarter was like, is this a make or break quarter? What's going to happen? There feels like there's less suspense here, at least around the car business itself. So what should we be paying attention to when it comes time for them to report and for Musk to appear on the call?
Yeah, thanks for having me, and good to see you again as well. It's a great question, because when we think about earnings, I mean, we know what the volumes were. They disclosed them earlier this month. We know we're down 14% year over year, a little bit below expectations. And I think on the auto side, I think the key focus is just kind of what has happened to the margins, right? And we've been kind of expecting, after what was a really healthy fourth quarter, some level of margin drop off. It's tied to a couple of things, one of which is the move to, moving the FSD purchase to a monthly subscription as opposed to a lump sum up front. So that weighs a little bit on short-term margins, but also just kind of the elimination of the EV tax credit and incentives and how that impacts things. What we really look for, and you kind of have noise throughout the quarter about what's going on with full self-driving and robotaxi, but I think progress and some concrete details around that, to me, are the biggest things to watch when we go through earnings here in the next couple of days.
And on the full self-driving point and on that subscription, that it's sort of transitioning to that, the Wall Street Journal just had a story on some class action lawsuits that the company is facing that have to do with sort of the promise versus the actuality of what FSD is capable of. And some early adopters who have said, like, I paid up front for this thing and it's not doing what it was supposed to do. Is that a material risk for Tesla?
I think one of the things that has been clear over the last couple of years is when you listen to conference calls, the CEO is prone to probably, I don't say over-promising, but enthusiastically expecting things to happen maybe sooner than they will. And I think on the FSD side, we've experienced it in multiple iterations over the last few years, and it's clearly significantly improving. But there are these hurdles to get over to kind of have full autonomy. As far as the class action suits are concerned, I mean, I think there's probably some element of risk to it. I don't think there's anything that would kind of create financial distress or financial concerns given the liquidity and size of Tesla. But it is something to watch for. It's not something that is kind of our top 3 or 4 list of things we worry about when it comes to Tesla, though.
Well, I guess it speaks then to the sort of bigger question of the cybercab, the robotaxi, and like how big that can be for the company. I mean, if they can't solve FSD, how are they coming out with a self-driving cab, right? They were supposed to start, or I guess they did start production this month, but when is that going to actually be a contributor to the company, and what kind of milestone should we be looking for there?
Yeah, and as you look at the rollout of FSD, and then subsequently, that clearly underpins the robotaxi business. Obviously, it's been slow, right? And I think we've all expected the progress to be slow. They did remove the safety driver, I believe, in Austin, but I think those vehicles are watched very carefully. The reality is that Tesla is the only one trying to solve full autonomy with cameras and AI only, right? Every other player has some combination of LiDAR and radar, and to me that remains the biggest risk to Tesla, and kind of clearly to our bullish thesis on the stock over time. But these milestones, I mean, we've written multiple times in reports. This is going to be a slow process. And as we look at the upside potential from robotaxi and FSD, it really comes from how things evolve in 27 through 30, not necessarily, the back half of last year in 26. Everybody wants, kind of ultra concrete short-term data points, but the process is going to take time. And I think that's where you'll see volatility in the stock. But clearly, to me, the biggest risk is just, can this be accomplished on a camera-based AI system only? And we clearly think it can, but they need to prove it. And if you look at the data, like if you look at the safety data that's been out there for Teslas, either with drivers and running on full self-driving, it's been very good. But to get over the regulatory hurdles and the legal issues, it's going to take time.
So how do you get to 508 from here?
Yeah, so the bulk of our valuation is really driven by a combination of the full self-driving initiative and the robotaxi business. If you look at sort of our upside scenarios, we take about 3/4 of the discounted value of those two businesses, and that really gets us to about 360-ish. The auto business combined with the battery storage gives us about another $100 of value, and then we actually subscribe a pretty small piece to the Optimus side. There's probably some upside. There's probably clearly some upside to what we're modeling for Optimus, but until we see more traction, we're pretty conservative on that. It's probably the one front where we've been conservative.
And then final question, with the SpaceX IPO coming, as I'm sure you're aware, there's been talk about the possibility of Tesla combining with SpaceX. Do you assign any probability to that one?
Well, never say never with Elon, clearly. There are clearly some interrelationships between the technologies that Tesla has designed, the manufacturing that they utilize between the auto side, and maybe some things that could help out on the SpaceX front, and where Elon's attention is. I will say, there's the IPO or pending IPO of SpaceX. It clearly does one thing, which I think is it eliminates Elon needing to sell stock to help fund some of the SpaceX build out. So I think that's ultimately a positive for Tesla. Whether there's a combination longer term, I mean, I wouldn't rule it out. It's not something we're building into our scenario analysis yet.
Gotcha. All right. To be determined on all fronts. Steve, thanks a lot. Appreciate it.
Thank you.
And before we go, we want to tell you about Yahoo Finance's new show, The Daily Wolf with Scott Melker. It premieres today at noon Eastern. It's a 15-minute weekday briefing designed to cut through the noise and deliver the day's most critical crypto developments. So make sure you don't miss that today. And there's much more else ahead on Yahoo Finance.